Hi, this is Randy Finney with Right Side of the Chart, and this is a morning market update for Thursday, October 18th, 2018. Just want to take a quick look at the charts because there are some levels to watch. One thing I'll say about the video updates on the broad market or any updates in general. I did have a request recently on the either on the site or the YouTube channel to do a regular more update at the end of the day. And I just want to say that I don't do that, and the reason is for this, and I don't post regular updates on the site. It's my belief that it will dilute analysis if you're seeing, let's say you're subscribed to a YouTube channel and every day there's a market update. Market's not doing anything for a long time. We're in one of those doldrums, whether it's grinding slowly higher or trading sideways. You tend to, after a few days of, 2 weeks or months of hearing nothing new to report, no technical developments, you probably stop checking those. So I'm of the mindset that if there's something worth pointing out, I'll do a video. Same thing with gold analysis on the site, oil, sectors, individual stocks. I don't update Apple every day, but all of a sudden I might be posting day after day because there's a lot going on there. So I wanted to share that, and it does go against the grain. When I open this website, the first thing I read, how to have a successful website, drive traffic in. There were the three most important things they said were content, content, and content, just like in real estate, location, location, location. I don't do that. I know it's and again, my site's not, ranked up there. I don't go for traffic. I'm not looking for that. I'm looking for really trying to design the best stock trading website on out there. And again, I know I'm digressing on this, but I want to let you know that's why these updates come when I see things. And for weeks and months, I'll always make sure to do at least a weekly market update. But that's what I wanted to point out. So enough on that. Here's the charts. These are the levels I've shown recently on this is ES, the S&P 500 E-mini futures, and the other day we had that, the big breakout. You can see a little, it was sort of a on the futures, this little area of consolidation here took the form of a triangle type pattern, broke out. But again, these were the levels that I mentioned back then, and they're still valid. You can see we went up to this one to the button. Look at that. That was a level I highlighted recently, 28, 26, 10, give or take. You can see lots of nice reactions there on ES. These again are the S&P 500 E-mini futures. Pulled back and we are back down to this level, which was a pretty significant resistance level. It was taken out on that big rip the other day. I'm referring to this big move here, but we dipped below it once. We're testing it again. And so really with ES, I'm going to get to some other levels. To me right now, it's more about NQ and QQQ. I know that this is a more diversified index. This is more representative of the stock market. But the QQQ is chock full of the beloved FANG stocks, FAAMG. That's a term I, gave to them a couple years ago, and everyone talks about the FANG stocks, and I wrote why things weren't really important. Netflix is way down the list as far as market cap compared to those other five. So those are the ones I watch, and I'll get to NQ in a second. But either way, choppy trading, keep that in mind. And what I wanted to point out too on the S&P 500 is, let's get to this chart here. Let's go to a SPY daily. This 279.26 is a big level. I've highlighted that recently. Bulls took it out the other day, but as I said, in a very volatile market, when volatility is expanded like this, you can expect overshoots, just like we overshot those supports on the weekly chart last week and we regained them. So we had a lot of momentum. That was a big up day, one of the strongest up days in a long time on last week, and or no, I'm sorry, earlier this week on Tuesday, and it carried us above there. But as you can see, look, a little doji stick right there. That can be an indecision topping stick, and we're right now flirting with it now at this point in time. So let's look at the S&P 500. That level on S&P 500 is, if these annotations load. There they go. Sometimes when you record the video, it slows this chart service down from loading. 2,800, and we're just below it now. Now, not by much. This can call it a back test. You have to give a, 2,000, almost a 3,000 point index. 1 point, 3 points, 5 points below is basically still on that level. Just want to point that out, especially intraday. But we are below it, and we're also, like I said, below this trend line. I have multiple trend lines, but there's a trend line there we back tested. So watch that. If they can't hold this 2,800 level, we start moving back down. And then again, go back to the intraday charts, and on SPY, I put a level right about here. You can see that's where we broke out. You can see all this consolidation. It's that same or ascending triangle that I was pointing out in the NQ futures right there, and that's the breakout. So you can see compression, compression, breakout, and then just all green candles. Came in for a near back test. This is the level to watch right now. It's about 20 on SPX, 2776, give or take. And for you SPY traders, I usually use SPY since that's what you can trade. And here, we'll modify that trend line right now. I had it right here, but I think at this point now we have this reaction there, almost one there, right about. So we'll call it right now on trend. So watch that trend line and watch 27.15, 277.15, I'm sorry. Or we'll call it 277. That's a level to watch on QQQ. I have more of a support zone from about 174.90 down to about 174. There's a trend line as well. We can again pull this out if we want to. The better fit is right about here on that trend line, really, to be honest with you, about here. So I think in this case, I'd like to run parallel trend lines. That looks pretty good right there because there's just those few brief spikes below. We'll call that the benefit of the doubt trend line right there, and we're flirting with it now. So there it is, but you still have, and again, I mentioned this, if you're bullish and you think this market's going to new highs or at least could rally for a few weeks, there's your objective long entries on a pullback to those levels. That should still be significant support. It was significant resistance recently right here, and so that's it. Now a break of that level, especially impulsive, especially a 60-minute or even better a daily close below would be quite bearish. Could bring us down quite a bit lower. So those are the levels I'm watching there, and to look at it on the daily chart. I've covered this recently about 178. That's pretty significant resistance there. That was an objective shorting up. Uh, and then that 174 level, you can see it there on the daily chart. That's where we broke out on Tuesday. 174 was around that top of that ascending triangle pattern there, and there's that big green candle, almost a 3% up day. So far, it looks like we faded about half of that. If we fade that whole candle, that's not good. There's no, if this market is headed up to new highs, anything is possible. When you get a big green candle like that coming off a correction, big green candle like that, that's usually it. That's it. That's a bullish sign, and the market should continue higher from here. It should not fade 100% and then some of that candle. At best, it can come down and maybe back test 174, and anything much below that is just not a good sign for the bulls. And so those are levels that I'm watching. And of course, there's this chart that I've been hyper focused on recently, the 15-minute chart of NQ, the Nasdaq 100 futures. And again, the salient levels that I'm watching are the uptrend line right here off last week's lows. As well, this is that the top of the ascending triangle pattern. And again, more importantly, it's good. It should be active support now on any pullback. A lot of reactions. That's where we were pressing, pressing, pressing. Finally, we broke out, unmistakable breakout because we had just a strong impulsive move after the breakout. But so far they're fading it. And like I said, they faded about half of that move. I think it started around here. I'd have to put up put up some Fibonacci retracements, but it doesn't matter. I can eyeball and tell you that's roughly half the gains. But here's the thing. Here's that pullback. Here's that trend line. So this is the first support level, pretty significant level to watch. You can replicate it. It shows better on NQ. That's why I'm using the futures because there's round-the-clock trades versus QQQ. So you'll see more reaction points, and it defines that trend line a little better. So bulls want to see this. Bears want to see this. And then again, bulls want to see that. If that breaks, hold of that level, bears want to see this. It's as simple as that. And then I, have a still, leaning towards a case that we're going to get this, and we're going to, if so, we'll probably return back to that waterfall type selling. The more you come down to those lows, and once you take out last week's lows, I think at that point it'll become clear to everyone that we're that this bounce was just a counter trend rally within a larger correction. Okay, and just a quick tidbit on trading, just some things I wanted to share. In fact, what prompted me is a member in the trading room made a comment about earnings and TSM, that's Taiwan Semi, with their earnings, and if they blow it away, then Apple should do very well because they make the semiconductor chips for Apple phones and others. So their logic was if they hit it out of the park, Apple's going to scream, and so on. Well, here, this is my reply, and again, take it for what it's worth. It's just things I've learned in the years of trading. I said I'm just going to read my reply because it's easier. I put it down in words. I'm reading off another screen. You bring up a couple of good points. Number one, volatility is already elevated due to the recent technical breakdowns and correction in the major indices. Now we're getting into the thicker earnings season, so I don't see that abating anytime soon. As such, one could most certainly be aware of when the stocks that they either plan to trade or are currently holding are scheduled to report, and then make the decision to either hold, fold, or hedge. Risk-averse traders, yes, that's an oxymoron, might opt to trade index or sector ETFs in lieu of individual stocks until earnings season is out of the way. My experience has been more often than not, which I have to put in quotations, is far from always. If a stock has a clearly bullish or bearish technical posture heading into earnings, the post-earnings move, regardless of whatever that knee-jerk reaction is, the post-earnings move, and I'm talking not just in after-hours trading or even the next day, I'm talking the move over the next few weeks, which trend is going to happen, is likely to go the way that the charts indicate. So in other words, when I look at Apple, for example, or even some better ones like Amazon, a lot of these stocks that have recently broken down from bearish rising wedge patterns or broke major trendline support or maybe flirting with trendline. Maybe they're still at key support, but there's big divergences. Those, in my experience, are if it's only a clearly bearish or a clearly bullish pattern, then, like I said, the majority of time, whatever the earnings, whether the earnings blow it away or not, that determines where the stock is going. Again, it's not always. If it was always, then you could bet it hard. But it's and trading's all about just putting the odds in your favor. There's no guarantees, so all you can do is sit back. If there's not a clearly bullish or bearish chart pattern heading into earnings, it is a crapshoot. You might as well go to Vegas, put it all on, red 18 or whatever, just roll and spin the wheel. All right, second point. I said I would caution you to assume that a positive or negative earnings report will mean that the stock will rally or correct from there. Sentiment ebbs and flows, and I've seen earnings seasons where there's a strong bid underneath the market that stocks could do no wrong. Earning beats were bought up, and just as earnings misses were bought up as well. So whether a stock beat or miss, the majority go up. And that's generally speaking. But on the flip side, I've seen stocks blow it out of the water only to fall considerably in the coming weeks. And again, putting any knee-jerk reaction, what happens right after, especially in after hours, and I'll maybe get to that in a second here. So I'm going to give you one example that stands out here, and I'll just finish my thoughts here. Well, we'll do this one. Let's just do that. All right, so this was a post I made back on April 28th, 2015. Um, and Apple blew it away. Apple, this doesn't show the intraday move. It was up high and it hit an all-time high that day. So Apple was looking just like it has recently, roaring, just a trend that just wouldn't end. Blew away earnings, beat all expectations. Guidance was good, but what happened is the technicals took over. I pointed out there was we'll look at the chart. Bearish engulfing candle, with the ramp up to new highs, and by the end of the day, they faded all those gains. And those are some of my favorite patterns or candlesticks. And then I went on to mention in this post, and again, you can reference that. Just go to the site, use the search function, and use Apple AAPL in all caps, and then the word bearish engulfing candle, and that should pull up this post first. So I pointed out the other divergent highs and the corrections, like I always do, pattern of divergent highs, correction. And this one was even better because as I always say, divergences in themselves are not a buy or sell signal. They are merely an indication of a trend reversal. You need a buy or sell signal. And that can come in two ways. You can get a break of the trend line, or in this case, a high probability reversal stick. If bearish engulfing comes at the end of a prolonged uptrend, those are high probability, especially, and as I mentioned here, if you get follow through the next day with additional red candle, a red candle or more, the more the better. So there it is. So I went on, and again, in the post, I go on to make the case, everything, how the long-term technicals, the whole case, and listed some price targets. And just to show you where that was from there, again, that was back in 2015, right here at the top. It was the high, and Apple from that day, that very day, dropped 34%. So that's its own bear market. So all I'm trying to do is make the point, and that's yes, one example I picked out. And if I cherry picked it, it's only because that one sticks in my head. That's Apple. That's the world's largest company. Everybody owns it. Most people own it or have owned it. And if you don't own Apple directly, you own it in your mutual funds. I will guarantee you that. If you have any growth mutual funds or stock funds, you have Apple. So that's that one. And I went on, let's see, to say number three, my final point about is that you need to be skeptical of the knee-jerk reaction following earnings. That was a good case. Apple soared in after hours. That wasn't even reflected in the chart I just showed you. That was a daily chart. Soared in Apple and after hours, and that's when they started fading it. So I said be skeptical of the knee-jerk reaction following earnings, as quite often that is not the lasting direction the stock will go. And just to digress, to add this in there. I always say that about FOMC meetings. When you're trading and you look at 2 o'clock, when the FOMC rate announcement comes out, you'll see the market rip up or rip down. And then it turns around, and almost always, about the one thing you can almost bank on is that the initial knee-jerk reaction will be faded. So you'll see the futures or the SPY, QQQ rip higher or rip lower, only to see it turn around 20 minutes later, 10 minutes later, and rip the other way, and then sometimes again. So stand aside and don't assume that whatever happens, if Apple, for example, this next earnings report blows it out of the water and you see after hours the stock being bid up, that doesn't mean it's going to go up for the next few weeks. In fact, that means very little. They could fade it. They report, by the way, on November 1st after the market close. All right, so to wrap this up, let's see. So I said be skeptical of the knee-jerk reaction. And then also keep in mind that following an earnings report comes a conference call with forward guidance. And I've seen stocks get crushed on earnings, and then forward guidance comes out. They give the conference call, and it's rosy. All of a sudden, that stock reverses and goes up. So if you're trading and you're watching what your stock does in after hours or pre-market after they report, don't freak out. And what I tend to do, if I have a position into earnings, I'll usually pull stops on the day of the morning of after the report comes, whether the report came that morning or most big companies report after the bell, not all, but most. And then just I'd like to pull my stops for a little bit just to let that initial knee-jerk reaction settle. Now, but what I do on the flip side, I leave my profit target in place because the goal on every trade is to have your profit target hit. So if that volatility spikes a stock or pulls it down to hit my target, great, I'm out. And that's what I wanted, and that's where I expected the stock to reverse. But on the other hand, I may, and of course it depends on the stock, temporarily suspend stocks because I've seen them open at 9:30. That euphoria from an earnings beat or the sell-off from a miss subsides, and then the stock ends up reversing by 10:30 and goes the other way. So that's another tip there. And so yeah, and of course wait for the conference call because that can change whatever happened right after earnings. And then I went on to say bottom line is that assuming an earnings beat or miss will determine where I'm sorry, I said assuming an earnings beat or miss, sorry, will determine where a stock is headed from there. It could prove to be a costly mistake. Better to let the charts be your guide, and unless you are an aggressive trader, stand aside and let the dust settle before taking a position on a stock that is scheduled to report. Um, again, you can use if you're risk averse, better off if you're an ETF, sector ETF, if you're bullish or bearish on the semis, you can play the ETFs. You're not going to get clobbered on a big earnings beat or miss because you have, in SOXX, for example, you have 30 different semiconductor stocks. So any one stock is not going to have a huge impact on the ETF. All right. And that's about it. Let's see. The last thing on your point about if TSM blows it away, Apple will rally. I went on to say the stock market has an uncanny way of pricing in most or all known variables. Those in the know, meaning insiders, fund managers, rubbing elbows up at the Hamptons, cocktail parties, they probably have a good idea what's going on with TSM and Apple already before it happens. And so when you look at the rise in the stocks, when you look at Apple, when you pull Here's a daily chart. Here's what Apple's done in the last 2 years. It's gone up 125% from this point right here at the low. So how much of any good news is priced into the stock? Maybe all of it, maybe not. But I wanted to just say that sometimes when you have blowout earnings, that's why you see a stock like I showed you back in 2015 turn around, and that was the top because all up to that point, all that good news, including that earnings report, had already been priced in. The market looks out 6 to 9 months ahead. So that's all I wanted to share. Is the takeaway from that is don't read too much into earnings. Let the charts be your guide, because by the time you read anything in the paper or hear it come out of somebody's mouth on CNBC, that is old news. I promise you that news, and some of that stuff is opinions, obviously, but I'm talking about the things you read about they just got a new contract in China or blah, 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 whatever fundamental reason, by the time you read about it, it is most likely priced into the stock and then some. We'll wrap it up here. I know that was a long ending rant, but again, those are tips that I like to pass along. It's at least how I trade, and hopefully that'll help you guys out as well. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.